Yes boys, how are we? And in today's video, the third and final one of all the concepts, we are going over liquidity. The reason why I did broker structure first and fair value gaps first is so you can learn them. If you haven't, go watch the videos, they're literally just before this one. So yeah, we've got the two main ones, but this is the most important one, because this is what forms it all together. This one, the liquidity comes first, then the fair value gap and the broker structure, etc. So let's jump straight into it and explain to you guys what liquidity is. A lot of people are thinking liquid cash. That is definitely true, but there's a bigger meaning in that. So let's go into it. So if you don't know, the main thing that moves the market is the banks. So if I came in here and placed £100,000 trade right here, the market wouldn't even move. But the banks are trading with £10 million per trade. So yeah, they're definitely moving the market very, very largely. They're moving it. So liquidity is where people's stop losses are. So the price wants to come up, take these out, and when the price goes up, people get in buys, so it goes up, but it's also taking people out with the stop loss, which was in sells. Do you get what I'm saying? So it's taking people out of the trade, and then it's also making people get in a trade because it's breaking structure, because it's sweeping the high. Do you get what I'm saying? It will make a lot more sense when I show it on here. But as you can see here, there are a load of people in sells right here. Banks, retail traders, everything. So if you think about it, there's loads of people in sells right here. Price needs to come back and take people out of these trades. So this would be liquidity. So price is going to want to come up to this high and take people out of the sells and also get people into the buys, because when price comes up here, people are going to get in buys, so it makes room for the big bankers to put big orders in, and then it's also getting people out of a stop loss. Do you get what I'm saying? Another thing, what liquidity is when the banks do these £10 million trades, they're going to move the market like this. So if, let's say they put a £10 million trade here right now, the price would just dump and they would get in late entries. So they'd be getting in here, they'd be getting in here, they'd be getting in here. What the bankers do is they move the price up so that it comes up here so they can get a better entry. I'll draw an example for you guys. So instead of them entering the trade here and dumping the market, because they're getting orders there, they'll get filled there, they'll get filled there. That's not going to work. So what they do is they send the market up here, take out this liquidity, so then they can get a better entry. So now they've entered all the way down, and they'll get filled there, 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 there. Do you get what I'm saying? So they need to take the market up, take people out of the trades, hit the stop loss, and then people are also going to get in the trade because of a breaker structure. So when the price breaks structure, most retail traders will get in buys. That's what I'm saying. People are in sells here, so price comes back up and takes them out of the trade, and then when price comes back up like this, people get in buys here. But when this gets swept, the price comes down, so it makes them lose their trade, and then price revisits back up, get them out the stop loss, and that's what liquidity is. Basically, it's very simple. Now I've explained it, I'm going to show you how to find it in the market, and then you use this with the other two things that I've taught you, the broker structure, fair value gap, you put them together, and it lays into a perfect strategy, which is what I'm going to get into right now. It should make more sense. Let's go. I'm going to show you how to find it on the high time frame, and then I'm going to show you how to find it on the low time frame, which gets you the trade for the day, and the high time frame gets you the bias for the whole week if you do it on the weekly, or for the whole day if you do it on the daily. So you find your daily bias, your weekly bias, align it with the short term bias, and get in the trade. That's how it works. So let's get into it. Right here, there are people in sells because people are trading from here down to here. So the banks need to come back up and take these people out of the trades, which is what they do here. They take people from going up, buying the market, and they take people out from the stop losses in the market. So this is liquidity. As you can see, as soon as this gets swept, what did it do? It goes down. Again, this would be the high. What does market do? It comes up and retakes its high. What does it do? Go down. So you could very easily wait for this liquidity sweep, which is here. Boom, it gets swept. You get a broker structure, which we get here. You can enter. That's the broker structure. But the correct way you would do it, you'd wait for a fair value gap. Let's say a fair value gap there, wait for it to get filled, broker structure again, enter on this candle, stops above these highs, and then you target the lower resting liquidity. So where is the lower resting liquidity? Here. There's people in buys there, so price needs to go there. There's people in buys there, so price needs to come down there and take these guys out. This is where the liquidity lays. So you'd have your stop loss around there, because liquidity is there, there, and there. And then when this gets swept, it's the same thing back up. Liquidity is being swept. Liquidity is being swept. Wait for a break of structure, which you learned in the last video. Stops there. Target this liquidity, because this then comes the last recent high. Just like this was the last recent low. Price revisited this low, goes up. Last recent high. Price revisits this high. Look, with the box. Comes up, goes down. Do you get what I'm saying? So that's using it in the market on on the daily time frame. So on the weekly, this is how you come into the market, right? So we're stopping the market here, right? On the weekly, you know price has swept this low, sell side liquidity. As you can see, it swept the sell side liquidity. So what is price going to want to do? Price is going to want to go back up here and take the people out on the sells. And what's up here? Liquidity. So price is going to sweep this and target this high. So let's just play it. Price has swept that, obviously. Price is going to want to make its way back up to this high. So let's say you got this liquidity sweep, broke of structure to the upside, which is what we learned in the last video. It's broken that structure. Boom, same thing. This is on the weekly. Obviously you do this on the intradays, but this is an example for you guys. Price is going to target these highs. We'll watch it play out together. So boom, that would be a safety trade right there. That'd be TP1, TP2, and we're literally doing this using the liquidity. I'm just going through this to show you guys where the liquidity lies. Liquidity here, right? So now price has gone up here. There's loads of orders here, but price needs to come back down. Obviously, when you align this with the market open on New York session, which is 230, you align the liquidity sweep with the broker structure, which is confirming it's going back in that direction. With the fair value gap retest to get the better entry, target the highs here, liquidity here, if you're going long, and that's how you do it. So this is just hindsight. Literally just hindsight. Now we're going to go and actually show you where to find it in the actual trade. So we've come into a session right now. Where is liquidity lying? So on the session, liquidity here, that's the high of the session. So this would be buy side liquidity, because that's the high of the session. Where will the low of the session be? Down here, which is the sell side liquidity. So now price has pushed past this liquidity, which has got people in the buys, as you can see here. So they're going to lose money, and it's got people out of the sells, which was making money all the way down there. So it's took people out, and it's got new people in, and that's what liquidity is. But now it's been swept, we're looking for shorts, which is the market going down. So we hop onto the lower time frame, boom, liquidity is being swept. So what we're looking for now, a reversal down, which would be a broker structure. Retest back into the fair value gap to get the better entry, and then we'll be targeting these lows. These lows and these lows. So let's just play it out and let's see how it goes. So it's swept buy side liquidity, we're looking for sells. And this is the market open, so you have to trade it at 230 every single day, and there'll be this liquidity sweep move. So it swept it. What have we got? Broker structure to the downside. Where's that? If you don't understand it, go watch the other video that I just did. Boom. Where is it? Red. So that's the broker structure downside. So we've had the liquidity sweep. It's going to get new people in, which is going to make them lose money. It's going to get people out the stop losses. So step one, liquidity sweep, which is here. People are in sells, price is bringing it back up to get them out of it, to cut the stop losses and get new people in so they lose money, and then they're going to make money going down. So liquidity sweep, the broker structure there. Now we're forming some gaps. So boom, What else did we learn in the other video? Fair value gap. The gap is from there to there. Price has left a big imbalance in the market where price will push back in and give you a better entry than just entering down here. So you're waiting for the retest back into the fair value gap, which has happened. You'd be going short when it taps into this, and you literally put your stop loss. You can either put it at these highs to be safe or above the stop loss. Where are we targeting the take profits? Liquidity. Even more liquidity. So you can even target down here. TP1, TP2. So we enter off the liquidity sweep, which we got here. Break of structure, which we got here, which is confirming we're going the correct direction. We then wait for the retest, which we got in this fair value gap. Put the stop loss here. We'd let it play out. Boom, TP1, TP2 hit. And yeah, TP3 get hit. You get the point I'm trying to show you though. So the main thing you need to drill into your head is the buy side liquidity gets swept, we're looking for sells. When this gets swept, the sell side liquidity, we're looking for buys. That's all you need to get into your head. Now to drill it even more, liquidity there, liquidity there, liquidity there, liquidity there. Where our price needs to revisit to take people out the orders. Do you get what I'm saying? Drill it into your head. So this was with a valid setup. Let's see, yeah, see, hits all TPs. Would even target obviously down here, even lower, 1 to 2 RR. These are just like these are literally just examples. So you've learned the break of structure, you've learned the fair value gap, you've now learned the liquidity. You put them all together like I've just done. It goes liquidity first, boom, swept. Break of structure second, confirming we are going that direction, which we got here, and then we wait for the fair value gap to get a better entry and a better RR. And then we put the stop loss above the recent highs, and then we put the take profits at lower resting liquidity, like here, here, and here. As you can see, the trade hit, and we would have made money. And that's how you find it in the market. That's how you use it for your bias, for the weekly bias, because prices are going to want to revisit the lower resting liquidity down here or up here, and that's how you find your bias. I hope that's made sense. We can go through one more example just to make sure that it's drilled in your guys' head. It's around 4 o'clock when I'm filming this video, so the price has already moved, but let's just go through it and give you an example on how we'd enter this trade. So 2:30 is opened. You'd mark out the highs of the session and the lows of the session. So be the high and the low, and the lower resting lows here and here. So if I was sat here now trading, I'd be looking for some longs up to these areas up here. We've had the break of structure to the upside. We've got the fair value gap. What's been tapped into, another break of structure. So then literally all I do is put my stop loss here and my TP at these highs and let them get hit, which they're going to get hit. And the stop loss at these lows. So if we came back to this trade in 2 hours, TP1, TP2, TP3 would be hit. And if not, it'd be a loss for the day. So 60% win rate, remember. So if we do 100 trades a year, 60 win, 40 lose, and you get the profit in the middle. Again, drill in your head one last time. What's happened while we took the trade? Liquidity has been swept, so we're looking for longs. Break of structure, which is further supporting our bias to the upside. We then wait for the retest, which we got here. We then enter, stops at the lows, TP1, TP2, and that's how you do the trade. So to sum it all up, liquidity is where orders need to get filled, stop loss needs to get out, and new people need to get in, so the banks can get in a better entry. And you can basically use this to trade to your advantage, as this happens every sweep. Look, sweep goes up. What happens here? Sweep of a sell goes up. It's everywhere. What happens here? Sweep, boom, go down. That's how you work it. If you need me to explain it anymore, give me a message, link in the description. I can help you all for free. Let's go.